Jump to a macroeconomic outlook. As you can see here, starting with rates, it's an important part to start when thinking about credit. We're at a point now with the Federal Reserve hiking interest rates since the middle of last year. We see the two-year rates at 4.2% are higher than 10-year yields of 3.6%. So we have an inverted yield curve, and the implication for that in credit is that shorter duration credit assets are highly attractive relative to longer duration because of this inverted yield curve. That's why we think that bank loans or floating rate broadly are interesting places to be now, given the yield backdrop that we have at the moment. What we see on this slide is that while we have elevated Fed funds rates right now, federal funds rate is 5.25%, that Fed funds futures project that rates are going to start falling, dropping to 4.4% by January of next year. I don't think, and I think DoubleLine's view is that this is, from a rate cut perspective, a little optimistic. We'll talk about in a minute how inflation remains persistent. And with the elevated inflation, it's unlikely that the Federal Reserve is going to back off of its hawkish stance. And so our expectation at DoubleLine is that the Fed funds rate remains elevated for longer than what this slide suggests. But even if you were to assume that this rate path actually comes to fruition, I think the implication for credit assets is that floating rate assets are still going to be highly attractive, because in an environment where the Fed starts cutting the short-term rates like this, you're still likely going to have a lot of carry in short rates, and it still would make for a very attractive environment for credit, particularly bank loans, even if you shave off, say, 60, 70 basis points from the all-in yield. As we look at further slides, you'll see that the elevated yields provide a lot of cushion, even if this scenario played out. Really, everything is about this slide, inflation. Inflation caused all the damage to financial markets last year, with CPI peaking at over around 9%, now coming back down at around 5%. It's still quite elevated. The economic forecast suggests that inflation is going to drop back to 2% in an orderly way. Our outlook at DoubleLine is that we don't think that's going to happen. We believe inflation is more likely persistent at an elevated rate. It's very likely that at the end of this year, 2023, we could have inflation in excess of 4%. That is not consistent with the Federal Reserve cutting the Fed funds rate, as the prior slide suggested. It's more consistent with the Fed remaining hawkish, committed to tamping down inflation, and that means higher for longer, and that means that floating rate assets or being short duration is an attractive place to be if we're going to have these elevated rates. Another element why we think that inflation is persistent is because unemployment is persistently low, with an unemployment reading of 3.4%, record low. It's hard to have a view that inflation is going to come down quickly. Low unemployment means strong wage growth, and with wage growth, it's hard to have a disinflationary environment. So the inflation reading, along with this unemployment rate, suggests that the Fed has a lot of work to do. And the only probably real fix for this is to keep hiking until a recession happens, but it doesn't seem that we're on the precipice of that at the moment. We do respect the data. There's plenty of macro data that suggests the economy is weakening. ISM numbers are one of them. The previously mentioned inverted yield curve is another. But just looking at ISM numbers for a moment, when you go below 50, that tends to be coincident with growing recessionary risks. You can see the manufacturing index is already below 50. The services index is still stronger than manufacturing. It's above 50, but you can see the trajectory here is going the wrong way. So the trend is not your friend. If you're looking for macroeconomic data to support the theory of economic strength, ISM numbers are not suggesting that. They're suggesting that the economy is decelerating and that there's a risk of recession as these continue to deteriorate. As I mentioned before, this is the yield curve. This is the 10-year versus the 3-month Treasury. It's inverted. Yields typically invert ahead of a recession. They forecast economic weakness. They don't necessarily mean the recession is imminent. This is a busy slide, but if you can see the red bars, the yield curve typically steepens back or de-inverts at the point of a recession. So while we have a deeply inverted yield curve, it doesn't necessarily mean a recession is imminent, that we're right on the front edge of it. It means that we're on watch for recession and that we would need this curve to de-invert or re-steepen to start to indicate that we're getting closer to recession. I'm going to skip this slide and move on to a bank loan outlook. Right now, you can see that SOFR on the top chart, the SOFR line in red is at 515 and the 10-year yield at 370. This inverted yield I've been talking about means you're really not paid to go out into longer duration assets. You can see on the bottom, which shows where the red, that's when SOFR is less than the 10-year, which is most of the time. And so most of the time you're paid to take incremental duration risk to go out on the maturity spectrum. Right now, that's not the case. You're getting paid to stay short. And that's what this slide suggests, that with this kind of differential of 145 basis points, differential between short rates and longer rates, that being short clearly at the moment is working. And this will work until the point where the Fed starts cutting, which would be when there are clear recessionary signals, which I think is going to take some time. So with these elevated short rates, you can see the black line, which is 3-month LIBOR at 530, and then the yellow line, which is all-in bank loan index yield at 1037. You're getting a lot of base rate and a lot of spread. The all-in yield of 10% is higher than any time since 2009. There's a moment in 2019 when there were elevated all-in yields, but that was a very brief moment in 2019, and then the Fed cut rates and this yield collapsed. I think that we're more likely to be in a period of persistently high rates and persistently high credit spreads, which I think make for a really interesting time in corporate credit. Given that we think that short rates are going to be elevated for some time because inflation is going to be persistent, I think I have the view, and DoubleLine has the view, that this yield on bank loans will persist for some time into the future. I would add that over 10% yield on bank loans gives you a lot of cushion for bad things to happen. People are trying to forecast whether a recession is going to happen. People are trying to forecast what the default rate will be. Let's just propose that the default rate is 5% over the next 12 months. And loans have a recovery of 50%, which is below historical averages. That's a 2.5% yield drag. If you're generating almost a 10.5% return, and you shave 2.5% off that, you still have plenty of yield. Even if that projection turns out to be overly optimistic, there is plenty of yield here to mitigate the risk of weakening economic conditions and default. I'd go even further to say, if you have an outlook that there are recessionary concerns and that you want to move up in quality and you want to have a yield less than the index, let's say 9.5 instead of almost 10.5, you can mitigate the default risk by just owning safer credit. And so that would also be a yield drag. But under that scenario, so-called scenario 1 is a scenario where you have index yield, but you have defaults. And scenario 2 would be you have less than index yield, higher credit quality, so you have less defaults. You're going to have a yield less than the 10.5%, but still very attractive. We're talking about 8, 9% yields, depending on how you put a portfolio together and how it moves through time. Still very attractive, even if you account for potential weakness that could occur over the next year or two. This slide is shorter in time series. It only goes back to May 2022. But what it shows is we've been, since the middle of last year, at a persistently high spread level. And there's further slides that help illustrate that. But this elevated spread level is compensating you for potential weakness that could be happening in the economy. I think the next slide illustrates it a little better. This illustrates the relative value between high yield and loans. Typically, high yield bonds yield more than bank loans. They're typically lower in the capital structure, unsecured, and you should get paid for that incremental risk. So high yield bonds are the gray line here, might be difficult to see on the slide. And the blue line represents leveraged loans or bank loans. And for most of the time, the yield differential shows that high yield yields more than bank loans for the reason I just mentioned. They're greater risk. We're at a point now where the yield relationship has inverted, where bank loans are yielding 200 basis points more than high yield, which doesn't occur very often. I think this is partly a phenomenon of the inverted yield curve, where short rates are higher than longer rates, and high yield is more benchmarked off of 5 and 10-year rates. I think it also represents some higher credit risk that exists in loans, which we don't want to ignore. The double Bs represent about 50% of the high yield index, but a much smaller component of the bank loan index. So a combination of rates and credit risk are the reason why bank loans yield more than high yield. But all things considered, you're getting, as I said earlier, paid a lot to take the incremental risk of loans. 10% gives you a lot of cushion for potentially bad things to happen. And a portfolio that you own over a multi-year period, I think will generate very high returns, even through the cyclicality that could materialize. Just another way to slice the relative value of loans versus other asset classes. Again, a busy slide. But what it shows you is the relative rank of each asset class over time relative to their average spreads. So up at the top would be 100% would represent the widest spread ever for an asset class. And at the bottom, which is 75th percentile rank on this slide, would show generally tighter spread for that asset class over time. What it shows is some of the traditional asset classes, investment grade corporate credit, high yield corporate credit, they're closer to the 75-80 percentile rank, elevated, but not at historically high rates. Same with emerging markets credit. And the Barclays Ag is in the 89th percentile. But you see above this dotted line, the areas of the credit markets that have the most elevated yields. And I think they represent a rate effect, but they also represent a level of stress that's in the market. It's no free lunch, but through stress comes opportunity. So bank loans are elevated. I think that that's partly because of a high base rate, high SOFR rate. It's also representative of the credit quality, the preponderance of single B credits, which represent elevated credit risk. And of course, the risk in bank loans are also represented in the CLO market, which is a securitization of bank loans. So you see double B CLOs are above the 90th percentile because of they're basically levered bank loans. And so they represent the same risk that bank loans represent. The other two areas that you see above the line, just for context, CMBS, I think spreads are wide to reflect the concern over office space utilization and the stress that exists from the pandemic work from home phenomenon. And then the widest on this is agency MBS, which is representative of the stress from the regional banking crisis, where regional banks own a significant amount of agency MBS, and they're looking to sell that, which is putting pressure on spreads. But you put that all together, you see that bank loans represent one of the widest spread areas in the market. So whether you have an outlook that's more pessimistic on the economic outlook, certainly if you have an optimistic outlook, then bank loans and these other asset classes are a screaming buy. But I think a more sober way to approach this is to say there are economic concerns on the horizon, there's risk of a recession, but these asset classes, including bank loans, represent a spread level that compensates you for those risks. I guess I'll also end on this by saying that it's very likely that the cycle that we experience now will be different than other cycles. Prior economic cycles since the financial crisis have been represented by rapid drawdowns, a rapid unwind of a great deal of risk taking, followed by the Federal Reserve reducing rates to zero and a rapid recovery. It's very possible that this cycle is going to be slow and gradual in terms of deterioration and spread widening and dispersion of credit. We think that that's an opportunity where up in quality can be great opportunities, regardless of asset classes, certainly in bank loans. One of the best ideas at DoubleLine has been BB bank loans because they have a very low probability of default and a nearly 100% recovery given default, and they yield north of 7%. For lower tiers of bank loans, single B and beyond, there are certainly credits that will survive whatever economic environment we're likely to face over the next few years. So with proper credit selection, it's certainly possible to generate a 9-10% return in bank loans over an extended period. I think this is a multi-year trade, not a trade for the next few months or maybe even the next 6 months. I'm going to end here on page 21 before I hand it off. This shows bank loan performance since 1998. And you can see over time, there's only been 3 years where bank loans experienced a negative return. 2008 is related to the financial crisis, where people had very levered portfolios that unwound rapidly. So you had a very rapid deterioration in performance, which you can see. And then 2022, pandemic year, and unwind of, not pandemic, but the unwind of the pandemic, tight rates and the Federal Reserve raising rates rapidly put stress on the market. And then 2015, which was an energy and China growth concern. But typically loans with a high coupon, particularly in an environment now where you have a 10% yield on the index and loans are prepayable anytime, so the good credits refinance and prepay, creates a strong counterbalance to weakness in the market. When you have that high carry and you have assets prepaying, you have the opportunity for very high returns, even in periods of stress, which is what this is showing over a long period of time. That generally you can generate positive returns in loans, even in periods of relative economic weakness. I would just point out 2002 as an example, 2018 as an example, and there are other periods that have been marked by periods of economic weakness where the bank loan market has found a way to generate a positive return.